The financial landscape for veterans is riddled with potential traps, and there is one specific move, often made with the best intentions of protecting a lifetime of savings, that acts like a flashing neon sign to both the Internal Revenue Service and the Department of Veterans Affairs. This isn't a small clerical error. It's a fundamental misstep in asset restructuring that can lead to denied benefits, prolonged penalty periods, and unexpected tax liabilities. If you are a veteran or caring for one who is contemplating applying for needs-based benefits, especially the critical aid and attendance pension, you need to understand this single, powerful mistake before you sign any document or move a single dollar. We are talking about the strategy of aggressively and often improperly transferring assets to family members or into specific types of trusts to meet eligibility thresholds, a maneuver commonly known as gifting gone wrong. This strategy, while seemingly straightforward on the surface, get rid of the assets so the VA sees you are poor enough to qualify, is the precise action that triggers two entirely separate yet equally devastating governmental reviews. It is the moment when attempting to secure long-term care funding inadvertently opens the door to a complex audit from the IRS and an immediate, often lengthy penalty from the VA. The core mistake, the foundational error that sets this whole disastrous chain reaction in motion, revolves around the misunderstanding of two completely different sets of rules governing asset transfers. On one side, you have the VA, concerned only with whether you are truly impoverished enough to qualify for their limited resources, particularly the aid and attendance benefit, which helps cover costs associated with daily living assistance. On the other side, you have the IRS, which doesn't care about your medical needs, but cares deeply about the transfer of wealth between individuals without adequate compensation, specifically watching for actions designed to avoid estate taxes down the road. The moment a veteran decides to transfer a significant portion of their wealth, say $150,000 in savings or a second property, to their adult children for $1, or perhaps just signing a quitclaim deed, they are crossing an invisible line that alerts both agencies simultaneously. This is not a matter of simply filling out a form incorrectly. It's a strategic failure where the veteran attempts to solve a VA eligibility problem using a method that creates an immediate and undeniable IRS reporting requirement. The sheer volume of the transaction, the lack of compensation, and the timing often coinciding with an impending benefit application all conspire to create the perfect storm of governmental scrutiny. When this transfer is executed without meticulous documentation and a clear understanding of the rules, the veteran is essentially sending up a flare, signaling to the federal government that a major, non-compensatory financial event has occurred, demanding inspection from two separate jurisdictions. This aggressive movement of capital, designed to rapidly deplete the countable net worth, is the initial and most potent red flag. The VA's red flag is immediately triggered by the 36-month look-back period, a rule instituted relatively recently to prevent precisely this kind of last-minute asset dumping. Before this rule change, veterans could move assets the day before applying and instantly qualify. That loophole is now firmly closed. The VA now requires applicants for needs-based pension benefits to disclose all asset transfers made within the 36 months preceding the application date. Crucially, the VA is not interested in why you transferred the assets, only that you did and how much was transferred for less than fair market value. If you gifted $100,000 to your daughter 30 months ago, the VA treats that as a disqualifying transfer. They view this action as an attempt to artificially lower your net worth to gain access to a benefit intended for those with genuine financial need. When they discover a substantial transfer within this window, the application is immediately stalled, and the VA begins calculating a penalty period. This penalty period is a block of time during which the veteran is ineligible for the benefit, calculated by dividing the total amount transferred by a specific monetary divisor set by the VA, which represents the maximum annual pension rate. For example, if the divisor is $2,500 and you gifted $100,000, you face a 40-month penalty period. The VA system is now highly automated to detect these transfers, and any discrepancy between the disclosed assets and financial records obtained during the verification process leads to an automatic deep dive review. This review is not a suggestion. It is a mandated investigation into the veteran's financial history for the previous 3 years, focusing intently on any large outflows of capital that do not correspond to typical living expenses. The moment the VA adjudicator sees a significant uncompensated transfer date within the look-back window, the application shifts from routine processing to high-risk investigation, guaranteeing delays and likely denial until the penalty period expires. But the VA flag is only half the problem. The IRS trigger is pulled the moment the transfer exceeds the annual gift tax exclusion threshold, misstep, which, for 2024, stands at $18,000 per recipient. This is the crucial intersection point that links the VA's benefit rules directly to the IRS's tax enforcement mechanisms. The veteran, in their rush to shed assets to qualify for the aid and attendance benefit, rarely stops to consider that the VA views this action as asset deprivation, while the IRS views it as a potentially taxable gift. If a veteran gifts $50,000 to a single child, that transfer immediately surpasses the $18,000 annual exclusion limit by $32,000. Under IRS rules, any gift above that $18,000 threshold must be reported to the IRS using Form 709, the United States Gift and Generation Skipping Transfer Tax Return. Now, it's important to clarify. The veteran usually won't owe tax immediately because the excess amount, $32,000 in our example, is subtracted from their lifetime unified estate and gift tax exclusion, a very high number, currently over $13 million. However, the critical point is the mandatory reporting requirement. Failing to file Form 709 when a reportable gift has occurred is a serious violation that triggers IRS scrutiny. The veteran has now engaged in a financial transaction that the VA flagged for benefit fraud deprivation and simultaneously failed to adhere to a mandatory tax reporting obligation, creating 2 separate governmental liabilities. The sheer scale of the asset transfer necessary to qualify for needs-based VA benefits, often transfers well over $100,000, means that multiple $18,000 exclusions are typically blown through in a single transaction, making the filing of Form 709 unavoidable. Ignoring this tax obligation because the veteran mistakenly believes they don't owe tax is the primary reason the IRS gets involved, turning a benefit application issue into a serious tax compliance problem. The PARM trust trap is another common pitfall where veterans attempt to shield their assets using legal instruments, only to find that the specific type of trust they chose still fails the VA's stringent criteria, while simultaneously creating complex reporting headaches for the IRS. Many veterans are advised to use an irrevocable trust, a trust where the veteran gives up all control and access to the assets, because this is the structure required to protect assets from Medicaid eligibility look-back periods, which are much longer, 5 years. However, the VA rules are slightly different and often more immediate. Even if the trust is irrevocable, the VA scrutinizes the timing of the transfer into the trust relative to the application date. If that transfer occurred within the 36-month look-back period, the assets are still deemed transferred for less than fair market value, and the full value of the transfer is used to calculate the penalty period, just as if the money had been handed directly to the child. The veteran mistakenly believes that because the assets are now legally out of their name, they are safe, but the VA sees right through this veil. Furthermore, certain types of irrevocable trusts, depending on how they are structured and funded, may have their own complex tax reporting requirements. While a simple grantor trust might be ignored for income tax purposes, the act of funding the trust with assets exceeding the annual exclusion is still a reportable gift on Form 709. If the trust itself generates income, that income must be properly reported, sometimes requiring a separate trust tax return, Form 1041. The complexity of trust taxation, combined with the VA's hardline stance on the 36-month rule, means that the legal solution intended to simplify eligibility often becomes a dense, expensive, and ultimately disqualifying financial complication that draws the attention of both federal agencies due to the magnitude and timing of the transfer event. This leads directly into the devastating consequence of the VA flag. The penalty period purgatory. Once the VA discovers the disqualifying asset transfer, the gifting gone wrong, they impose a mandatory penalty period. This is not a fine, but a period of absolute ineligibility for the aid and attendance benefit, regardless of the veteran's current financial or medical need. Imagine a veteran needs $5,000 a month for assisted living care. They gifted $150,000 2 years ago, thinking they were safe. The VA calculates a 60-month penalty period. For the next 5 years, despite being financially and medically eligible today, they receive $0 from the VA. This is purgatory because the veteran often needs the funds now, and the penalty period severely strains the family's resources, potentially forcing the veteran out of necessary care. What makes this penalty particularly punitive is that the veteran cannot simply undo the transfer. The assets are legally gone, and the VA still imposes the penalty based on the historical action. Moreover, the VA is extremely rigid in recalculating the penalty. If the veteran made multiple gifts over the 36-month period, the VA aggregates all of them, leading to a cumulative penalty that can stretch for years. Families often find themselves in an impossible bind. They transferred the money to protect it, but now they are forced to spend down their remaining limited resources, or even ask the recipient child to return the funds, while they wait for the penalty period to expire, all because they failed to wait the full 36 months before applying, or failed to understand the VA's specific needs-based requirements. The penalty period is the VA's ultimate enforcement mechanism against asset deprivation, turning a hopeful application into a multi-year financial crisis. Compounding this is the consequence of the IRS flag. The reporting requirement nightmare. Form 709. Nama. While the VA is dealing with the penalty period, the veteran is now facing the IRS for failure to file the required gift tax return. The IRS does not care about the VA's look-back period, they care about compliance. If the VA audit reveals that a $100,000 transfer occurred and the IRS cross-references this information, which they absolutely can and do, they will check whether Form 709 was filed for that tax year. If the veteran failed to file, they are subject to penalties for failure to file and failure to pay, even if no tax was ultimately owed due to the unified credit. These penalties accrue monthly and can quickly become substantial. Furthermore, the act of filing Form 709 is complex. It requires meticulous tracking of who received the gift, when, and the fair market value of the asset transferred. If the gift was a piece of real estate, the IRS requires proper valuation documentation. If the transfer was structured incorrectly, such as a gift that doesn't qualify as a present interest gift, the annual exclusion might be denied entirely, further increasing the reportable amount and accelerating the use of the veteran's lifetime. Exclusion. For many veterans and their families who are focused entirely on the medical and eligibility crisis, navigating the intricacies of gift tax reporting is overwhelming, leading to non-compliance. This non-compliance transforms a financial planning error into a formal tax audit risk, forcing the veteran to hire specialized tax counsel to resolve issues that originated entirely because they tried to circumvent the VA's asset limits without proper tax foresight. The IRS does not forgive non-reporting easily, and the penalties serve as a stark reminder that every major financial move has tax implications, regardless of the veteran's immediate need for government assistance. The true danger lies in the interconnected audit risk, the mechanism by which the VA and the IRS can share information, turning a single mistake into a joint federal investigation. While the agencies operate under different mandates, they are both parts of the federal government, and data sharing, particularly concerning large unexplained movements of wealth, is increasingly common. When a VA adjudicator sees a massive asset transfer during the look-back review, they document it extensively. If the VA denies the benefit and the case is reviewed or appealed, the documentation detailing the transfer is part of the public record within the VA system. Similarly, if the IRS initiates an audit due to failure to file Form 709, they are investigating the same transfer event. There are formal and informal channels for information exchange. For example, the IRS may be alerted to suspicious financial activity through banking records or FinCEN reports, and the VA's investigation can provide the context necessary for the IRS to pursue a tax liability claim, or vice versa. The most dangerous scenario is when the veteran attempts to provide conflicting narratives to the two agencies. Perhaps they tell the VA the transfer was repayment for an old debt, to avoid the gift classification, but they fail to report it as income to the recipient or fail to file the required Form 709 with the IRS. This contradictory documentation immediately escalates the situation, suggesting an attempt to mislead the government. The interconnected nature means that the veteran is no longer fighting one bureaucracy. They are potentially fighting two, each with its own set of penalties, deadlines, and legal requirements, all centered around that single, poorly executed asset. Transfer designed to secure eligibility. Finally, the path out of this complexity lies in understanding the proper legal alternatives, strategies that legally and safely manage assets without triggering the look-back penalty or the IRS reporting requirement. The single most crucial piece of advice is patience and timing. If asset transfer is necessary, it must be completed, just outside the 36-month look-back window. Waiting the full 3 years before applying for the aid and attendance benefit is the simplest way to legally shield the assets from the VA's scrutiny. Furthermore, instead of outright gifting large sums, veterans should focus on spending down assets on exempt items or services. The VA allows unlimited spending on medical care, home modifications for accessibility, like ramps or walk-in tubs, paying off debts, mortgages, credit cards, and purchasing necessary equipment. These expenditures legitimately reduce the veteran's countable net worth without triggering a gift tax obligation or a VA penalty period, because the money was spent for fair market value. Another safe harbor is the purchase of an annuity for the community spouse, the healthy spouse, provided the annuity is actuarially sound and meets specific VA requirements. This converts a countable liquid asset into a stream of income for the spouse, reducing the veteran's net worth while providing financial security. Utilizing these legal strategies, spending down on approved items, paying off debt, and ensuring timely asset transfers avoids the catastrophic gifting gone wrong scenario. It replaces the risky last-minute transfer with a methodical, compliant financial plan, ensuring the veteran achieves eligibility without incurring penalties or inviting the unwanted joint scrutiny of the IRS and the VA. The takeaway is clear and urgent. The financial move that flags both the IRS and the VA is the substantial uncompensated transfer of assets, gifting, within the 36 months preceding a needs-based VA benefit application, especially when that transfer exceeds the annual gift tax exclusion. This single action creates dual liability, a mandatory penalty period from the VA for asset deprivation and mandatory tax reporting requirements, Form 709, from the IRS for the gift. Attempting to navigate the complexities of long-term care eligibility requires recognizing that the VA and the IRS operate on different timelines and with different goals, and a move that solves one problem can instantly create a far worse one with the other agency. For veterans seeking peace of mind and necessary benefits, the only safe strategy is one built on compliance, either waiting the full 36 months after a transfer or utilizing approved spend-down methods to legally reduce countable assets, thereby securing the aid they deserve without the risk of audit, penalty and the nightmare of dual federal scrutiny.